All right, today we're going to pull back the curtain on a really powerful and often totally invisible force that basically dictates the market's mood. It's like this hidden engine humming just beneath the surface, and once you understand it, it can completely change the way you see the financial world.
So let me ask you a question. Have you ever had a trading strategy that just works? You know, it's a thing of beauty. You're buying the dips, you're selling the rips, everything is clicking, and then one day, it just stops. For no reason you can see, it completely falls apart.
Suddenly, the dips just keep dipping. The rips just keep on ripping. The market feels like a runaway train, and that brilliant strategy of yours, it's getting absolutely crushed. And you're sitting there just scratching your head, thinking, what on earth just changed? Well, the answer is usually hiding in plain sight in the options market.
Okay, so here's the game plan. We're going to break it all down. First, we'll reveal this hidden engine and show you how to decode its signal. Then, we'll get into why the market's biggest players are basically forced to act in predictable ways. We'll simplify the whole thing down into two basic market moods, and of course, show you how to trade them. Let's dive in.
So, that mystery of why the market can just flip its personality overnight, it really comes down to one signal. It's called gamma exposure, or GX for short. Honestly, the best way to think about it is like a weather forecast for market volatility.
So what in the world is GEX? Well, in the options world, gamma just measures how fast an option sensitivity to the stock price changes. So gamma exposure, GEX, is simply the total gamma that all the big market dealers have to hedge. By watching this number, we can see what their collective bet is. And here's the kicker. If you know their position, you can predict how they are mechanically forced to react. It's literally like someone handed you their playbook.
And listen, this is not just some abstract theory. This has massive, real-world consequences. Just look at the crazy event known as Volmageddon back in February 2018. In the days before the crash, the market was still cruising near all-time highs. But GEX was flashing a huge red warning light. It turned deeply negative. And then, bam, the floor just fell out. The VIX went ballistic and the market plunged. And here's the why. This is the crucial part. The source material puts it perfectly. Dealers were short gamma, and their hedging accelerated the sell-off. Get this, they weren't just reacting to the sell-off. Their own required hedging was actually pouring gasoline on the fire, making everything so much worse. I mean, the impact was just massive. A 10% drop in the S&P 500 ETF. And here's the thing. Traders who were watching GEX saw the storm clouds gathering days before it hit. Everyone else? They were completely blindsided. This is the power of understanding what's going on under the hood.
Okay, so to really get what happened during Volmageddon, we have to decode this GEX signal. And really, it all boils down to a fundamental conflict, a huge tug-of-war between two kinds of options, calls and puts. And they create totally opposite forces in the market.
Now this right here is probably the single most important idea to get. Seriously, when dealers sell call options to people, their hedging activity actually creates a stabilizing force. They become like shock absorbers for the market. But when they sell put options, their hedging creates a destabilizing force. They become market amplifiers, making little moves into huge ones.
And I've got to say this again. This isn't about what dealers want to do or what they think is going to happen. It's about what their risk models force them to do. Their hands are tied. And these automatic, robotic actions are what end up shaping the entire market's behavior.
So let's break down that stabilizing force from calls. When dealers are short calls and the stock starts to rise, they have no choice but to sell stock to hedge. If the stock falls, they're forced to buy stock. Now just think about that for a second. They are systematically selling high and buying low. That's a powerful break on the market, and it's what creates those calm, range-bound environments.
Okay, now let's flip that completely on its head and look at the destabilizing force from puts. When dealers are short puts and the stock starts to fall, they are forced to sell even more stock into that weakness. And if the stock starts to rally, they have to buy into the rally, chasing it higher. They are systematically selling low and buying high, the exact opposite of the old saying. And that is the rocket fuel that creates those powerful runaway trends.
So we have these two opposing forces constantly at war with each other. The beauty of GEX is that it takes all of that insane complexity, every single call and put option out there, and it distills it all down into one simple gauge. Is the net result positive or is it negative?
And this dynamic creates two totally distinct market regimes, or you could just call them moods. When the net GEX is positive, the call options are in charge.
The dealers are those shock absorbers, and you get a calm, range-bound market. But when GEX flips negative, the put options take over. The dealers become amplifiers, and that's when you get a volatile, trending market. Now, within this whole framework, there's one specific price level that is incredibly important. It's called the zero gamma level. You can think of this as the tipping point, the absolute line in the sand. This is the exact price where the market flips from being stable to being volatile.
So this is way more than just a cool theory. It's a super practical tool. The big question is, how can you actually use this information? Well, you can turn this GX data into a simple, actionable framework for your trading.
The strategy really just boils down to this. When GEX is positive, you expect low volatility. That's a great environment for mean reversion strategies, fading the moves. But when GEX turns negative, you expect high volatility, and that's a much better time for momentum strategies. In other words, riding the trend. And if it's kind of neutral in the middle, well, that's a pretty good signal to be cautious.
So think of GEX as your new market compass. If it's positive, dealers are stabilizing things. You can fade the moves. If it's negative, dealers are amplifying things. You want to ride the trend. The key takeaways are, always know where that zero gamma level is, and just as important, use this info to manage your position size. A negative GEX environment is not the time to be a hero.
So there you have it. The market isn't just random noise. There's a hidden engine, a mechanical force shaping its behavior every single day. The real question is, now that you can see how the engine works, what are you going to start looking for?